Hey, how are you? This is Nick Stern. Thanks for tuning in. No, I'm just being funny. Thanks for tuning in to another topic discussion. I know it's been a little while. Going forward, just FYI, there's probably going to be more like around one a quarter. I'm going to try to be, still helpful. I'm still here and whatnot. But I think it just makes more sense to put out a video more like one a quarter versus once a month. Plus, I want to make sure that the information that I'm providing is still fresh and makes sense and is helpful because that's what is intended. So I'm going to jump right in. So what I wanted to do is give you a bit of an investor series. In the investor series so far we've covered general markets, we've covered mutual funds, ETFs, exchange traded funds. What I'm going to talk about today is stocks. Why would an individual stock, make sense over a mutual fund or an exchange traded fund? And I'd say one, it really is going to be dependent upon your overall financial situation. I know you've heard that before, but it's true. Also, it's going to depend upon how you feel about risk. So risk is always really important, and the shorter timeline that anyone has in general, risk is always greater. Because even if we have, let's say, a short-term loss and your timeline is a year, and there's some volatility like we've had in 2018, and your timeline was May, for example. So you bought a stock, and it was, if you bought it on January 1st, maybe it was doing pretty well up until the end of January. Well, then now that stock is most likely down, or maybe it hasn't recovered from its highs. Or let's just say you had the same June timeline and you bought the same stock or even a market index fund at the end of January. Well, then you'd probably be either flat or even down. So the fact that your timeline of using that money is only a couple months, the risk is significant because, one, anytime you invest any money into the market, it is never guaranteed. It can always fluctuate, and you could, yes, hypothetically lose the entire amount that you put in. So, one, you always have to be prepared for that. Two, of course, security selection is always extremely important, understanding what you're investing in, which is why I think some people steer clear of individual stocks or equities because there's just more movement day to day, both up and down, and there can be the perception that it's a little bit more scary because there's more volatility. And when you're seeing something move a little bit more than, let's say, a mutual fund, maybe that drums up more, I'm just sitting down here, more emotional reactions, which in general really does not bode well for anyone's investment portfolio. And we really want to try to not make decisions based on our own emotions, but rather on our initial thesis as to why we invested in something, regardless of what it is, the overall reasoning, and again, really important, timeline. So you can look at words from Warren Buffett's 2017 annual letter to investors, and I think that there's some really good excerpts in there, one of which, from a general standpoint, the further out that you go on a timeline, it allows for volatility to occur without necessarily impacting your immediate cash flows. And for compliance purposes, but also for reality purposes, what I mean by that is, I mentioned that 6 month, 5 month. Well, if you need that money in 5 months, we're always going to tell you to keep it in cash because the risk is too great basically for the loss. But if it's, let's say, 10 years, and of course, there's no guarantees, but there is a greater chance that you will be positive at the end of 10 years than there is at the end of 6 months or 5 months or 4 months. Plus, if there is that same short-term volatility, you have the time period to basically sit through that volatility, get through the volatility, and hopefully wind up positive and above whatever volatility, meaning you are receiving capital appreciation. So the longer out that you go, in particular with individual stocks, because there's just more inherent volatility on a day-to-day or in a shorter-term basis, it just there's generally or can be it makes more sense. I don't want to say less risk, but the short-term volatility that you may or may not experience with an individual stock that was generally just going to be more than some sort of fund, you are able to potentially weather that better with a longer-term timeline than you would be with any type of short timeline, in particular because of those day-to-day, month-to-month, even year-to-year